Listen carefully to earnings calls in 2026 and you'll notice something subtle. Executives sound steady, guidance is measured, capital plans are described as disciplined, liquidity positions are emphasized, risk management is mentioned frequently, but what stands out is not panic, it's preparation. Which raises the question, are U.S. companies preparing for something they're not saying out loud? On the surface, financial results across many industries look stable, profits are holding, margins are being protected, hiring is controlled but not collapsing. Yet beneath that surface stability, corporate behavior has shifted in ways that suggest heightened caution. Cash levels are rising, debt maturities are being extended, capital expenditures are phased rather than rushed, supply chains are diversified even at higher cost, energy contracts are locked in years ahead. These are not random adjustments, they reflect strategic positioning. So what might companies be preparing for? The first possibility is prolonged uncertainty rather than a single dramatic event. Over the past several years, businesses have experienced rapid interest rate changes, geopolitical disruptions, regulatory shifts, and demand volatility. Instead of reacting to each shock individually, companies may be preparing for a structural era of unpredictability. In other words, they are preparing for instability as the norm. Liquidity offers the clearest signal. Many U.S. companies are holding larger cash buffers than in prior expansion cycles. That does not necessarily signal fear of an imminent recession. It signals desire for optionality. When conditions are unclear, cash becomes leverage. It allows companies to absorb shocks, move quickly on opportunities, or pivot strategies without scrambling for external financing. But liquidity also sends another message. It suggests that executives believe future conditions could tighten quickly. Access to capital markets can change fast. Credit spreads can widen. Investor sentiment can shift. Holding cash is a way of reducing dependence on external confidence. Are U.S. companies preparing for something they're not saying out loud? The answer may be yes, but not necessarily something specific. It may be a mindset shift rather than a forecast. Another sign is the recalibration of growth expectations. Aggressive expansion has given way to selective investment. Companies are focusing on core competencies. Peripheral initiatives are being evaluated more strictly. Hiring growth is aligned closely with confirmed demand rather than optimistic projections. This does not look like contraction. It looks like insulation. Insulation from what? From overextension, from demand miscalculations, from building cost structures that cannot flex when conditions change. Artificial intelligence is another area where preparation is visible. Firms are investing heavily in infrastructure, data centers, chips, networking, energy partnerships, but they are staging deployments carefully. They are securing long-term supply agreements and locking in power access years in advance. That kind of preparation suggests awareness of constraints ahead. Energy availability, semiconductor supply, cooling infrastructure, regulatory oversight. These are not hypothetical risks. Companies may be preparing for bottlenecks rather than collapse. Energy in particular has become strategic. Data center expansion depends on grid capacity. In several regions, that capacity is tight. Firms that secure power contracts today are protecting tomorrow's growth potential. That is preparation, not panic. Geopolitical complexity adds another layer. Trade policies, export controls, and global tensions have introduced uncertainty into supply chains. Many corporations are reshoring or nearshoring portions of production. Redundancy is being built into procurement systems. Redundancy costs money. Companies would not absorb those costs unless they believed fragility carried greater risk. The shift from efficiency at all costs to resilience by design signals a structural change in corporate thinking. Are U.S. companies preparing for something they're not saying out loud? It could be as simple as preparing for slower growth. After years of expansion fueled by cheap capital and rapid digitization, economic growth may settle into a more moderate phase. In slower growth environments, efficiency matters more. Margins are harder to expand. Competition intensifies. Preparing for that environment means tightening operations before pressure arrives. Look at how companies are guiding. Forecast ranges are often wider, language is more cautious, the emphasis is on flexibility rather than certainty. That tone does not imply imminent crisis, it implies humility about forecasting. There is also the possibility of regulatory evolution. Technology companies in particular face increasing scrutiny. Data privacy, AI governance, antitrust concerns, and digital platform regulation continue to evolve. Corporations may be preparing for stricter oversight without publicly speculating on policy outcomes. That preparation can involve restructuring divisions, adjusting compliance budgets, and refining governance frameworks long before rules are finalized. Then there is the psychological dimension. Executives who have navigated recent volatility carry those experiences forward. Institutional memory influences strategy. Companies that once operated with minimal liquidity and aggressive leverage have learned the cost of thin buffers. Preparation becomes embedded in culture. Importantly, silence does not necessarily signal hidden knowledge of a specific crisis. Public companies are constrained in what they can disclose. Often they prepare broadly rather than for a singular event. Stress testing downside scenarios is now standard practice. Planning for slower demand, tighter credit, supply interruptions, or energy constraints is part of modern corporate governance. What looks like silence from the outside may simply be prudence inside. From the outside, this preparation can look like excessive caution. Critics may argue that companies are underinvesting or moving too slowly, but from inside, a boardroom, caution may feel rational. Are U.S. companies preparing for something they're not saying out loud? In many cases, they are preparing for volatility itself. They are preparing for interest rates that may stay elevated longer than expected. Energy systems under sustained strain. AI infrastructure demands that outpace supply. Geopolitical tensions that disrupt trade routes. Consumer behavior that shifts faster than models predict. None of these require a dramatic announcement. They require structural readiness. The current corporate posture reflects adaptation, not fear. Companies are engineering balance sheets to withstand shocks. They are pacing investments to preserve flexibility. They are building supply redundancy to reduce fragility. Preparation does not always mean anticipation of disaster. It can mean recognition that the environment is structurally more complex than it was a decade ago. In 2026, the loudest headlines focus on transformation and disruption. But inside corporate America, the dominant theme may be resilience layered beneath ambition. Are U.S. companies preparing for something they're not saying out loud? Perhaps not for a single looming event, but almost certainly for a world where surprises are no longer surprising, where capital is more conditional, where infrastructure constraints are real, and where stability must be engineered rather than assumed. And in that world, preparation is not fear, it is strategy.